I'm Dean Koutsamides, Managing Director of Equity One Mortgage Fund Limited. This is the first of a series of podcasts where we will try to communicate the latest developments in Equity One and what's going on for our investors and our commercial borrowers. So the first one, I thought it would be only fitting to give a little bit of a background as to what Equity One does, who we are as commercial lenders and fund managers. But before I get into that, I'm going to go over the obligatory compliance disclosures, which I haven't memorised yet, so I'm just going to read it out. So any opinions expressed in this post are general in nature and don't take into account your personal objectives, financial situation, or needs as a potential investor. You should, before making any decision, consider the appropriateness of the advice having regards to your objectives, financial situation, and needs. Our PDS, or our product disclosure statement, is available on our website, which you can see at the bottom of the screen right now. And you should consider the product disclosure statement before deciding whether to invest. So now that that's all done, a lot of people, when they first contact us, want to know very generally what it is that a mortgage fund is. Now, a mortgage fund can vary in structure, and its offerings to investors can be quite different. There are unitised structures where people own, or investors actually have shares or units in an underlying pool of investments. Or you can in fact invest in a mortgage fund as a debenture, or you can invest in a contributory mortgage fund like ours, which essentially is investments in a specific transaction. Now, I'll elaborate a little bit on this. So, when you're investing in Equity One, you don't own units in Equity One, you don't invest in Equity One, you don't have shares in Equity One, and it's not a debenture in Equity One. What it is, it's an actual loan to an individual or a company, and you invest in the specific mortgage. So who are our clients? Essentially, we look after two groups. We look after our commercial borrowers, and we look after our investors, also known as members. So let's talk about our commercial borrowers first. The reason somebody comes to Equity One for a commercial loan is predominantly because they thought they had their ducks in a row to get funding from their source, usually a major bank. But for some reason, that hasn't quite occurred for them. Now, they're not necessarily uncreditworthy, they're not in trouble, they're not distressed. However, they've gone and transacted on a property, they've bought a property, or they're seeking to refinance a property, and their expectations of getting some commercial finance from a major lender hasn't actually worked out the way they want to, or hasn't worked out in the timing that they were hoping to do. So what happens is, for example, if Sally goes and buys a commercial property, let's say a factory in the Melbourne suburb of Sandringham, very nice suburb for those of you who aren't from Melbourne, and let's say Sally goes and pays $2 million for a factory, has her 30, 40 or even 50% deposit sometimes, so she has substantial equity, and was expecting that the bank, and I won't name any banks, but let's say a major bank with a yellow and black brand, actually didn't come to the party in time. So Sally needs to find some sort of alternative source of funding until such time as the major lender comes to the party, and that's where we come in. So we'll lend Sally a first mortgage to 50, 60, sometimes 65 or 70%, depending on the quality of the asset, for a period typically of 1 year or 2 years, until such time as Sally gets her ducks in a row and is able to go back to a major bank or actually dispose of the property or do what actually Sally intended to do with the property. So that's where we are relevant in the commercial borrowing space. And all of our loans, borrowers can pay out at any time, even though it's a fixed rate of a year or two. Sometimes they can be more than a year or two. And they can break these loans or break the contract and get out with no, we call it break costs. Other people call them penalties, but they're really break costs. So we don't have any of those for for our loans where people want to get out before the end of the term. So it gives people flexibility and it gives people a solution. So they're our commercial borrowers over here. So if, for example, we lend $1 million to Sally, and we have a first mortgage over Sally's factory where she's bought it for $2 million, and we get it valued by our independent valuer, and the sworn valuer confirms that it's worth $2 million at the time that she bought it. We will lend her, for example, $1 million and take a mortgage over that specific asset purchased by a specific borrower. That's a mouthful. The investors, the members, actually invest in that particular $1 million mortgage. So a member can elect to contribute the entire $1 million, or they can elect to contribute a portion of the $1 million, $50,000, minimums of $5,000, right up to whatever works for them. So you might find some of our mortgages have one investor tied into it, or you might have half a dozen, which is not uncommon. So by the very nature of this structure, Equity One is called or referred to as a contributory mortgage fund, meaning the investors contribute to the actual transactions and own those transactions. Now, what this means for investors is that you as a member get to select the investments, get to choose and approve the investments that you want to invest in. We actually do all the due diligence, we do the valuations, we do all the legal due diligence, we do the identification due diligence, we do the credit checks, all of the underlying credit work, if you like, on the borrower and the actual mortgage and the transaction. And that in itself is quite detailed and is probably worthy of a separate podcast altogether, and I've just had a good idea, I might do one separately about that. But we do all that work, and then we present those investment opportunities, also known as the mortgages, to our investors, and we send those investment opportunities out by an email broadcast. And you as an investor get to select or choose which one you want and how much you want. So that's in essence how it works. If you're interested in investigating whether you'd like to invest in Equity One, or in fact if you'd like to borrow from Equity One, please don't hesitate to contact us on the website at the bottom of this screen. And you can also contact us through our socials on Facebook, LinkedIn and Instagram. And apart from initially speaking to myself or any one of the members of the team here, who are very helpful and very friendly, we can also post you out a little information book that gives you some basics on what we do from an investment and a borrowing side. And also our product disclosure statement can be sent out to you and is also available on our website. So that's the introduction, and I look forward to talking to you again real soon with some more developments. Okay, bye-bye.